Hey everyone, and welcome back to the Modest Wallet, where we want you to be modest with your wallet, but ambitious with your goals. If you've been watching the headlines, you know we're in the middle of a bit of a roller coaster ride when it comes to tariffs, trade wars, and international uncertainty, and it's shaking up the stock market in a big way.
It's been a pretty wild ride.
Tariffs have been front and center in the financial news, impacting global supply chains, causing price swings, and sending investors scrambling. So, today, I'm breaking down the best stocks and sectors to invest in during heightened U.S. tariffs, including defensive plays, domestic gems, onshore winners, and even some alternatives like gold and crypto.
I'm ready to learn.
So stay tuned. Sean here with the Modest Wallet. Let's get into these 5 different options for investing when U.S. tariffs are in play.
But I'd also like to round up the tariff to 20%.
First on the list are defensive sectors, which are steady in the storm.
Steady.
Let's start with the defensive sectors: consumer staples, healthcare, and utilities. These are the essentials. People still buy food, they use electricity, and go to the doctor even when trade tensions are high.
Tension. There's tension.
Some key stocks and ETFs that might be part of this are Procter & Gamble, ticker symbol PG. It's a household name in consumer goods. Think things like Tide, Pampers, Gillette. It has a long history of consistent dividends. Then you have Johnson & Johnson, ticker symbol JNJ. It's a diversified healthcare giant with pharmaceuticals, medical devices, and consumer health products. It's resilient and very stable. Duke Energy, DUK is the ticker symbol. One of the largest utility companies in the United States, providing electricity to millions across the Southeast and Midwest. Then we have the Utilities Select Sector SPDR Fund, which is ticker symbol XLU. It's a popular ETF that gives you broad exposure to U.S. utility stocks. There's the Fidelity MSCI Utilities Index ETF, which is ticker symbol FUTY, and this is a low-cost alternative for utilities exposure. Some of the pros for these stocks and ETFs include lower volatility, steady dividends, and historically strong in downturns. The cons include it has some slower growth, and it can lag behind in bull markets. Now, these sectors are like financial comfort food. They're steady and reliable when markets get jittery, so that's why we included them. All right, second on our list are domestic-focused industries, keeping it local.
It's too close to home.
So our domestic-focused stocks, these companies do most of their business right here in the U.S., so they're less exposed to international trade risk. Some of the top picks that we found are the Spider S&P Regional Banking ETF, ticker symbol KRE, which is focused on banks with limited international exposure, giving you a way to ride U.S. economic growth. Then there's the iShares Core S&P Small Cap ETF, ticker symbol IJR. This tracks small cap US companies that typically have some domestic exposure. Then there's the Vanguard Small Cap ETF, ticker symbol VB. This is a great low-cost option that offers a broad small cap exposure. The Fidelity Small Cap Index Fund, ticker symbol FSSNX, is a mutual fund alternative if you prefer Fidelity. And the pros to these include that it's less affected by tariffs, the growth potential if the US economy stays strong, and it's great for diversification. As far as cons, it is vulnerable to US interest rates, and smaller companies can be more volatile. So regional banks and small cap stocks are like the hometown heroes of your portfolio. They stay close to home and avoid the global drama. Third are our onshoring winners, bringing it back to the United States.
Go back to America.
With tariffs making overseas production more expensive, many companies are bringing their manufacturing back home. And that's a huge opportunity for industrial automation firms. So some to watch are the Rockwell Automation, ticker symbol ROK. It's a leader in industrial automation and smart manufacturing solutions. They help factories become more efficient and US based. And there's the Vanguard Industrials ETF, ticker symbol VIS. This gives you broad exposure to US industrial firms, including Rockwell, Honeywell, and others that benefit from reshoring. The pros for these include direct beneficiary of onshoring trends, the long-term growth potential in smart manufacturing. As far as cons, it is sensitive to capital spending trends, and it may not be recession-proof. Think of companies like Rockwell Automation as the backstage crew making the US production boom possible. They're not flashy, but they're crucial. Fourth on the list are e-commerce platforms, those adaptable giants.
Adaptability.
Tariffs can raise prices, but companies like Amazon and eBay have something traditional retailers don't, and that's scale and flexibility. Their third-party seller networks and global reach help them pivot when needed. Pivot! Some of the top picks in this include Amazon, ticker symbol AMZN, the e-commerce king with logistics, cloud services, and an enormous seller network that allows it to adapt rapidly. There's eBay, ticker symbol EBAY, a more niche play, but eBay's auction-style platform and global sellers give consumers alternative buying options. And there's the Vanguard Consumer Discretionary ETF, ticker symbol VCR. This includes Amazon and other e-commerce and retail players. Then there's the Fidelity MSCI Consumer Discretionary ETF, ticker symbol FDIS. This is a low-cost alternative with similar exposure. The pros for this include diverse supply chains, and it can shift sourcing quickly. Also, the e-commerce trend is still growing. As far as cons, it's heavily scrutinized on pricing and logistics costs. Another con is Amazon's margins are very thin. So in uncertain times, flexibility is power, and these e-commerce giants are some of the most adaptable businesses out there. Fifth on the list are alternative assets hedging the chaos.
It's been pretty chaotic.
When markets go haywire, investors often turn to alternative assets, especially gold and crypto.
Crypto is out there.
Some ways to invest in this are in the Spider Gold shares, ticker symbol GLD, one of the most popular gold ETFs that directly tracks the price of gold. Then there's the iShares Gold Trust, ticker symbol IAU. This is a lower fee gold ETF alternative to GLD. Fidelity's Physical Gold ETF, ticker symbol FGLD, a newer entrant offering direct gold exposure with no investment minimum. There's Bitcoin ETFs like ProShares Bitcoin Strategy ETF, BITO, or you can just do direct purchases through platforms like Coinbase. Some of the pros include its historically good hedge against market volatility, it's non-correlated to stocks, and can protect purchasing power. As far as the cons, gold offers no income or dividends, and crypto is highly volatile and speculative. Now, these aren't for everyone, but for many investors, having a small portion in gold or crypto can balance out the risk of your core portfolio. Investing during times of high US tariffs doesn't have to mean panic. It means strategy. Focus on what's stable, invest in what's local, hedge where you can, and most importantly, don't let short-term noise derail your long-term goals.
That noise.
What noise?
Drop us a comment below. Are you investing differently with all the tariff talk? If this video helped you, don't forget to like, subscribe, and hit that notification bell so you never miss a financial tip.
Like, follow, subscribe.
At The Modest Wallet, we'll help you to be modest with your wallet, but ambitious with your goals. I'll see you in the next one.